Most traders believe the best trade is the biggest trade. They load the boat all at once, pray, and wonder why they're liquidated before the real move even starts. This belief system is so deeply embedded in retail trading culture that it goes almost unquestioned. Walk into any trading forum, any Discord channel, any social media comment section, and you'll see it everywhere. Traders celebrating their conviction plays, their all-in bets, their willingness to risk everything on a single signal. The narrative is seductive because it feels like courage, it feels like confidence, it feels like the kind of boldness that separates winners from followers. But this narrative is a lie that destroys accounts at scale. Jesse Livermore learned this the hard way, and his lesson cost him nearly everything he had built. In 1907, at the height of his early power, Livermore spotted what he believed was a major market inflection, a pivotal point where price was genuinely ready to break. All the signals aligned, the tape confirmed. His conviction was absolute, so he did what he thought a confident trader should do. He put his entire position on immediately. He loaded the boat. He committed fully. The move came just as he predicted. But it came in waves, not in one smooth line. The market didn't gift him a straight path to profit. Instead, it tested him. Every pullback triggered his stops. Every hesitation made him doubt his analysis. By the time the real momentum arrived, when the move became undeniable and unstoppable, Livermore was already out, watching from the sidelines as his would-have-been fortune unfolded without him. He'd been right about direction, but he'd been wrong about entry, and that mistake cost him millions. Here's the brutal truth that separates professionals from the masses. Entering full size on day one is not courage. It's arrogance masquerading as conviction. It's confidence without proof. It's betting the farm before you even know if the farm is worth defending. The amateur trader confuses certainty with confidence. He believes that if he analyzes hard enough, thinks clearly enough, and studies enough patterns, he can predict exactly when a move will begin and how it will unfold. This belief is foundational to why 94% of traders lose money. They're betting on perfect timing in a market that rewards patience instead. The professional trader knows something the amateur doesn't, and this knowledge gap is the entire reason one builds wealth and the other builds regret. Confirmation takes time. Price doesn't just move. It tests, it rejects, it coils. It shakes loose the weak hands before it accelerates. And if you're already all in on the first signal, before any of this confirmation process has unfolded, you'll be stopped out before the proof arrives. You'll be liquidated in the noise before the signal becomes clear. You'll be another statistic in the 94%. This is where the one-quarter layering method enters the game. This isn't a new concept. Livermore used it extensively in his later years after he learned his lesson. Professional floor traders in the 1950s built fortunes on this principle. Modern hedge funds that outperform the market year after year use layering as a cornerstone of their position management. But somehow, in the age of instant execution and social media swagger, layering has been forgotten. Traders have gone back to the all-or-nothing mentality that destroys accounts. The method is elegantly simple in concept. Instead of one bet, you make 4 smaller bets. Instead of risking all your capital on unproven strength, you scale in as the trade proves itself to you through measurable market action. Instead of white-knuckling through every tremor and pullback, your hand. Muscles staying clenched for hours, you add only when the market gives you explicit permission, when it shows you real, measurable confirmation through price action, volume, or volatility metrics. But here's what separates understanding the method from profiting from it. The genius isn't in the layers themselves. Anyone can divide a position into 4 parts. What matters is what the layers do to your mind. They replace fear with protocol. They replace hope with process. They replace the 94% failure rate amateur behavior of loading the boat and praying with the deliberate patience that separates the wealthy from the wiped out. When you layer, you're not hoping for a perfect entry. You're building a system that catches the move even if you miss the exact start. You're staying in the game long enough for your thesis to prove true. By the end of this video, you'll understand exactly how to use this method to turn choppy, uncertain markets into a staircase that climbs directly into your account. You'll see how to enter small, add on proof, and exit in tranches while the money still flows your direction. You'll learn the exact protocol that Livermore refined over decades of trading and that modern professionals use every single day to compound wealth systematically. But first, you need to understand what most traders get wrong about position sizing. You need to see exactly why Livermore himself had to nearly go broke to learn the lesson that will transform your account. The story isn't just history, it's the blueprint for your future. Picture this scenario, and be honest with yourself. You've lived it. You've identified a setup. All the pieces align. Volume confirms the move is building. The chart screams opportunity from every angle. Your analysis is solid. You've done the work. You've studied the pattern. You've checked the fundamentals. Everything points in one direction. So you buy 1,000 shares in one block. You execute the entire position at once because waiting feels like weakness, like you don't truly believe in your own analysis. You hit the buy button with conviction. Your stop loss is set 2% below your entry. You tell yourself this is reasonable risk management. You sit back and wait for the move to unfold. Within hours, sometimes even within minutes, a minor pullback hits. This isn't a reversal. This isn't the thesis breaking down. It's completely normal market behavior. Traders take profits. Institutions rebalance. News hits that's tangential to your thesis. The market tests your resolve. Your position is down 1.8%, then 1.9%, then 2%. The market touches your stop loss. Click, you're out. The execution is instant. The psychological impact is devastating. You've just realized a $200 loss on a $10,000 position. That's money that came from your account, from your effort, from your life outside the market. The loss is real and immediate. Then, exactly 3 days later, something infuriating happens. The stock continues higher, exactly as your original thesis predicted it would. You were right. Your analysis was sound. Your direction was correct. And the stock rallies 15% from your entry point. If you had held for just 72 hours, you would have turned that $10,000 into $11,500. Instead, you're sitting with a $200 loss, watching from the sidelines as your would-have-been fortune unfolded without you. Your hands are clenched. Your jaw is tight. You're wondering what went wrong with your analysis, your timing, your skill. But here's the part most traders never understand. Nothing went wrong with your analysis. Everything went wrong with your execution. Here's what actually went wrong, and this distinction will change how you trade for the rest of your life. You tested your thesis with insufficient proof. You didn't give the mark. Enough time to confirm what you already knew to be true. You made a declaration on day one, and then demanded immediate vindication. But markets don't work that way. They never have. They never will. When you size the full position on day one, you're making a specific bet that deserves to be stated clearly. You're betting that the market will confirm your conviction immediately. You're betting that price will never pull back before it moves. You're betting that your entry is so perfect that the market will reward you without testing you. But markets don't reward prediction. Markets reward patience. Markets test. They shake out the weak. They create multiple entry points for those patient enough to wait for them. The market exists to humiliate people who are certain. It exists to reward people who are flexible, the professional trader, the one whose account grows year after year, decade after decade, who compounds wealth systematically, understands this fundamental truth about how markets actually work. He knows that a move of any magnitude is never built in a straight line. It's built in layers. A stock that rallies from $50 to $100 didn't do it in one smooth, uninterrupted ascent. Instead, it built on small pushes higher, pullbacks that shook out the weak, consolidations that allowed new buyers to enter, and retests of key levels that proved support was holding. Each microsurge attracted new buyers into the position. Each pause attracted new conviction. This is how real money moves through markets. The one-quarter layering method mirrors this exact rhythm. It doesn't fight market structure. It aligns with it. Instead of one $10,000 position that you pray will work immediately, you build 4 $2,500 positions that you deploy strategically across time and confirmation. You enter the first quarter on your initial signal, just as you would have before. But now, instead of being all in and panicked, you're only 25% exposed. You enter the second quarter when price confirms and holds above a key resistance level that previously rejected buyers. The third quarter comes when momentum accelerates, when volume spikes, when the move becomes undeniable. The fourth layer, your final pyramid, Livermore's term, arrives only when the move is so compelling that everyone can see it, not just you. What happens when you execute this way? 3 concrete, measurable things unfold. First, you stay in the trade. You're never all in. so a normal 2% pullback doesn't liquidate you. You're never panicked because you've sized small enough that you can tolerate the noise without emotion. You're never stopped out by normal market behavior because you've built in the buffer that layering provides. Second, you average up only on strength, never on desperation. Every new layer you add is earned by the market through measurable confirmation, not given by your hopeful prayers. You're not averaging down into a failing thesis. You're averaging up into a winning one. Each addition to the position is justified by real price action, not faith. Third, and most crucially for your bottom line, your cost basis improves dramatically because you're buying closer to the real breakout, not chasing the phantom signal 3 days too early. Think about the math here. If you enter quarter 1 at $50, quarter 2 at $51, quarter 3 at $53, and quarter 4 at $55, your average cost basis is $52.25. Meanwhile, the trader who entered all at once at $50 and was stopped out never benefits from any of the moves above $50. He's sitting in cash or in a loss, wondering why he was right about direction, but wrong about execution. The layered trader is systematically buying at better and better prices as the thesis proves itself. Single entry trading forces you to prove your entire thesis on day one, in the first few hours of trading. It's like trying to judge a book by reading the first paragraph. Market pullbacks that are completely normal, expected, and healthy become catastrophic stop-loss triggers that liquidate you before the real move even begins. The one-quarter method distributes your entries across time and price confirmation, keeping you in the trade while simultaneously filtering out false signals. Each layer you add buys at better prices than the fear-driven first entry would have captured. Professional traders build positions like professional builders construct buildings, one tested level at a time, never overextending into unproven strength, always waiting for the foundation to be proven before adding the next floor. Now we move from why to how, and this transition is where theory transforms into actual money in your account. Understanding the philosophy of layering is valuable, but philosophy doesn't pay your bills. Execution does. The one-quarter layering method requires a specific, repeatable framework, and Jesse Livermore was obsessively committed to frameworks. He wasn't a free spirit trader who followed his gut and hoped for the best. He was a systematic operator who kept detailed charts. He marked pivotal points with precision. He had written rules for stops, rules for taking profits, and rules for when to add to positions. There was no improvisation in his approach. There was no gut-feel decision-making. Everything was process. Everything was protocol. This distinction between the trader who improvises and the trader who executes a predetermined system is the difference between someone who occasionally gets lucky and someone who builds generational wealth. Here's the exact protocol that separates professional position building from amateur hope-based trading. This isn't theoretical. This is what actually works in live markets. Entry 1, which Livermore Cal led the initial signal, is where your thesis enters the market. You've identified your setup through whatever edge you possess, whether that's volume confirmation, price action patterns, technical indicators, or fundamental catalysts. Your analysis points to an opportunity. You buy 25% of your intended total position size. This first quarter is your thesis entry. Think of it as a question posed to the market. Am I right about this direction? If the market proves you wrong, you're out a small amount of capital. The loss stings but doesn't cripple. If the market proves you right, you're in the game with capital committed at an optimal price before confirmation arrives. Your stop loss is set one legitimate technical level below your entry point. This could be a support break that would invalidate your thesis, a moving average that you were using as a structural level, or a swing low that represents true technical weakness. Nothing vague, nothing arbitrary. The stop exists at a level where, if price reaches it, your thesis is objectively broken, and you exit immediately. Entry 2, the confirmation layer, comes when price holds and closes above a key resistance level that previously rejected buyers. This is the crucial distinction. You're not buying on hope or FOMO. You're not buying because the stock is moving, and you feel like you're missing out. You're buying because the market just provided measurable proof that your thesis was correct. Price tested your conviction and validated it. You add another 25% to your position, bringing your total commitment to 50% of intended size. This second entry stop loss is tighter than the first, usually sitting just below the pivot point you just conquered. the resistance level that just proved to be support. Your cost basis is improving because you're buying at a higher price, which seems counterintuitive until you understand that this higher price represents confirmed strength, not hoped-for strength. You're buying proof, not potential. Entry 3, the momentum layer, arrives when price is genuinely running. Volume is accelerating beyond normal daily averages. The move is no longer theoretical or confined to your analysis. It's real and visible to everyone watching the tape. You add your third quarter, bringing total position size to 75% of intended exposure. This is where amateurs get frustrated with themselves because they're annoyed they didn't buy bigger at entry 1. They're kicking themselves for being patient. But they're completely missing the critical point. Patience here is exactly what keeps you in the trade. If you had loaded the boat at entry 1 and taken a wider stop loss, a normal 3% pullback would have liquidated you before entry 2 and entry 3 ever materialized. Your patience isn't weakness. It's the mechanism that allows you to compound the winner. Your stop loss is now tighter still, sitting just below the last pullback, typically 1 to 2% below current price. You can tolerate this tight stop because you've already proven the thesis, and you're no longer betting on unproven direction. Entry 4, the final pyramid, is Livermore's term, and it captures the psychology perfectly. By the time this entry arrives, the move is unmistakable. Everyone can see it now. CNBC is talking about it. Your barber is asking about it at the next haircut. This final 25% that brings you to 100% of intended position size is the victory lap. You're not trying to catch the entire move in this final layer. You already own 3/4 of your position, and you've proven the thesis across multiple confirmations. This last piece is simply maximizing the back half of the trend you've already established and proven. Your stop loss moves up to break even on your original entry 1 or slightly below entry 2. You're no longer protecting against thesis failure because the thesis is proven. You're protecting against trend reversal, which is a different animal entirely. Here's the non-obvious part that separates this system from random trading. Each stop loss is progressively tighter. This seems backwards to many traders, but it's the core of the professional approach. Why does this work? Because with each confirmed layer, you have exponentially more proof. Unproven theses, those early entries based on analysis alone, justify wider stops because you're genuinely uncertain whether the market will confirm your thinking. Proven moves, those later entries added after price action has validated your thesis, justify much tighter stops because the thesis is no longer uncertain. You're not protecting against being wrong about direction, you're protecting against the trend ending or reversing. This is how professionals protect their edges, while staying fully committed to winning positions. Livermore called this entire approach waiting as a position. This phrase is so misunderstood by modern traders. When Livermore said he made money by sitting, traders assumed he meant doing nothing, but that's not what he meant at all. You're not doing nothing. You're not timing the market perfectly on the first try. You're actively building proof, layer by layer, moment by moment, and you're withdrawing your risk exposure slowly as your conviction solidifies through market action. You're waiting, but you're waiting as someone with capital committed, not as someone on the sidelines watching. The 1/4 protocol has 4 distinct entries, and each one is triggered by measurable confirmation rather than arbitrary timing or your emotional state. Entry 1 tests the thesis with minimal risk so that you can stay alive if you're wrong. Entries 2, 3, and 4 add to the position only as the market proves strength through price action and devolume. Stop losses progressively tighten because unproven hypotheses require wide protection while proven moves require only trend protection. This architecture ensures you never risk too much capital on unproven signals while simultaneously staying fully invested in moves that actually work. Amateurs see 4 entries as indecision, as a sign that you don't really believe in your thesis. Professionals see it as disciplined capital allocation, as the systematic deployment of risk across time and confirmation. This is the difference in how money accumulates. Let me tell you about a trader named Marcus, because his story is the story of 99% of traders who eventually figure this out, and the remaining 1% who never do. Marcus was smart, really smart in the ways that matter for technical analysis. He could read charts better than most traders you'd encounter. He had studied price action extensively. He had a genuine edge in identifying trend breaks, those critical moments when price moves from accumulation into acceleration. His problem wasn't intelligence. His problem was psychological, and it was fatal to his account. He was too confident. The moment his analysis aligned perfectly, the moment all his signals confirmed and the setup looked undeniable, he loaded the boat. He committed fully. Sometimes it worked. Sometimes he'd enter right at the beginning of a move and ride it for substantial gains. Often it didn't work. Often the market would test him in ways he didn't anticipate. His overall win rate was 52%, which is above average for retail traders, but his account shrank anyway. This is the most frustrating experience in trading because it proves that win rate isn't everything. When he was wrong, he was catastrophically wrong, taking large losses that wiped out multiple winning trades. When he was right, he only captured half the move because his greed made him overtrad. On winners, and give back profits that he'd already earned. Then one day, Marcus learned about layering. Someone recommended he read Livermore's journals. He saw the one-quarter method documented and decided, with nothing to lose since his current system was destroying him, to try it. The psychological shift was immediate and profound. Instead of needing to be absolutely perfect on day one, needing to pick the exact bottom tick and having the market immediately validate his genius, he just needed to be right about direction. That's a vastly lower bar. His first quarter wasn't a declaration that he was a market wizard. It was a simple question posed to the market. Is this the direction I think it is? That's easy to answer with just $2,500 at risk. Easy enough that his anxiety dropped dramatically. His clarity improved because he wasn't fighting his own psychology anymore. He wasn't white-knuckling through the first 2% of movement praying that the market would immediately validate him. He was simply testing a hypothesis with a small amount of capital, but the real psychological win came later, when entry 2 arrived. When the market confirmed his thesis through measurable price action, when price held above a key resistance level and closed there, something fundamental changed in his brain chemistry. He felt relief, not excitement. He felt vindication, not greed. He'd been right. The move was real. It wasn't theoretical anymore. Now, instead of acting on faith and hope and the fear that he was missing out, he could act on fact. He could add to his position knowing that the market had provided proof. Adding to a winning position is entirely different psychologically from entering a new position. It's not gambling. It's not taking a shot in the dark. It's compounding proof. It's saying I was right before the market confirmed it, and now I'm making a larger bet on the thing I already proved. Livermore understood this psychological dynamic profoundly, and he wrote about patience constantly. But here's what most traders misunderstand. He didn't mean passivity. He didn't mean sitting on your hands doing nothing. He meant active waiting. He meant sitting with a small position, watching for confirmation, and then expanding only when the facts justified expansion. He had specific language for every element of the system, because language shapes behavior. He called stops insurance, not failure. This reframing is powerful. If you call a stop loss a failure, then stopping out feels like defeat. But if you call it insurance, it feels like prudent risk management. He saw adding to winners as pyramiding, not averaging down. Averaging down has connotations of desperation, of chasing losses. Pyramiding has connotations of building something, of compounding an advantage. The language matters because the language shapes behavior, and behavior shapes results. When you layer, you're not chasing a move. You're confirming your thesis. When you stop at 2%, you're not cutting losses in a way that suggests weakness or poor analysis. You're respecting the tape. You're honoring what the market is actually showing you rather than fighting it. When you wait for entry 2 instead of going all in at entry 1, you're not missing the move. You're waiting as a position. You have capital in the game. You're participating. You're just doing it with wisdom. This reframing destroys fear and replaces it with protocol. And protocol compounds over time because protocol keeps you in games you win while exiting games you're losing before they become financial disasters. Marcus tracked his results religiously after implementing the one-quarter method. His win rate stayed at 52%. This is important to understand. The method didn't magically make him right more often. His analysis was still the same. His edge was still the same. But his account grew 34% in the year after implementation compared to the previous year where it had shrunk despite a 52% win rate. How is this possible? The math tells the story clearly. The 52% of winners were now capturing 70% of the move on average instead of 40%. He was staying in winning trades longer because his stops were tighter, and his position sizing was smaller, so normal pullbacks didn't liquidate him. The 48% of losers were costing him 1.2% per trade instead of 4.5%. He was limiting damage because he wasn't all in on every entry, because he had a framework for cutting losses quickly before they became catastrophic. The math of patience and discipline. The one-quarter method transforms the psychology of trading by completely reframing what entries mean. They're not declarations of absolute confidence in a move. They're questions. They're hypotheses. Each layer brings a specific psychological reward, relief and confirmation, rather than anxiety and unproven hope. This psychological reset is exactly where 94% of traders fail. They can't tolerate ambiguity. They can't sit with a small position and wait for proof. Their psychology demands that they either load the boat and go big or stay out entirely. So they load the boat, and when the normal market pullback comes, they panic exit on noise. Professionals reframe patience as active waiting. You're in the game, you're at risk, you're committed, but you're not overcommitted. They reframe layering as compounding proof. Each entry is a validation of the thesis, not a new independent bet. When discipline replaces genius chasing, when protocol replaces intuition, account growth becomes inevitable. The trader wins not because he's smarter than other traders or because his analysis is superior. He wins because his psychology is superior, built on a foundation of protocol instead of ego. This is the inheritance that Marcus claimed, and it's available to you if you're willing to trade ego for discipline. Now here's where most traders break their own system, and this is the moment where discipline either becomes habit or collapses into emotion. They learn to layer in. They study the framework. They execute it perfectly for weeks or months. The position builds exactly as planned. The move unfolds in the waves they anticipated. And then, at the exact moment they should take profits, the moment they've been waiting for, they freeze. Fear paralyzes them. They start asking themselves, how high can this go? And what if I sell and it keeps running? They become victims of greed masquerading as conviction. Or worse, they panic and exit all 4 quarters at once, dumping the entire position on the market when they finally feel confident it's working. They leave 60% of the potential move on the table because they couldn't execute the exit as systematically as they executed the entry. Livermore had a specific rule for this exact moment, the moment when the trade is working, and your psychology wants to take control. He called it running the stop. When a position proved itself massively, when it had moved 5%, 10%, 15% in your favor, he would tighten the stop loss progressively and let the winning position run. But he would simultaneously peel off quarters at key resistance levels. This wasn't contradiction, this was sophistication. He was protecting his gains while maximizing his exposure to the winning move. He was saying to the market, I'm confident enough to stay in this, but I'm disciplined enough to take profits systematically. Here's the counterintuitive part that separates professional exits from amateur guessing. You exit the same way you entered. You don't enter in one block and exit in stages. You don't enter in stages and exit all at once. You exit in quarters, just as you entered in quarters. Why? Because positions don't need to end all at once any more than they needed to start all at once. This is a principle that applies to how markets actually move. The move that took 4 layers to enter will often take 4 exits to maximize. The move that built on pullbacks and retests will also exhaust on pullbacks and retests. And in the volatility between your 4 entries and your 4 exits, you capture far more by being systematic than by trying to time one perfect exit. Systematic beats perfect every single time in trading because perfect never comes, but systematic always works. Here's the exact framework for exiting in quarters. Exit 1, which professionals call the profit-taking quarter, arrives when the position moves 5 to 8% in your favor. Your thesis is confirmed. You've proven you were right about direction. You remove the first 25% of your position at this early resistance level. This isn't cowardice. This isn't lack of conviction. This is banking the thesis. This is taking the money that validates your original analysis and removing it from risk. Your cost basis is now fully recovered. Plus, you have 25% of the profit locked in. You're now playing with house money on the remaining 3 quarters. You literally cannot lose money on this trade anymore. The first quarter is gone, booked, safe in your account. The psychological relief is enormous. Exit 2, the momentum acceleration quarter, comes when price breaks. through that initial resistance and accelerates higher. Volume spikes. The move becomes undeniable. You remove the second quarter, perhaps at 10 to 12% profit. You've now locked in substantial gains on half of your total position. Half your position is crystallized profit. Half your position is still in the game, still at risk, but now it's the half that came from your bonus house money, not yo. Or original capital. The position is now tilted entirely in your favor. You cannot lose. You can only make more or make less than the maximum. Exit 3, the trailing quarter, is where you let the momentum run, but you protect yourself from reversal. The move is still running, but now you're in unproven territory. You're higher than any resistance level you identified in your original analysis. This quarter doesn't exit at a predetermined price. It gets a trailing stop instead. You're not exiting here unless the move breaks and reverses. You're actively riding momentum, but you're protected by a stop loss that sits 2 to 3% below the last pullback. If the move continues, you stay in. If the market shows you weakness, you exit. You're allowing the market to tell you when to get out instead of trying to predict it. Exit 4, the victory lap, is whatever remains. Either the trailing stop hits and you're out, or the move finally exhausts and the stock rolls over, and you exit at market taking whatever remains. Sometimes that final 25% is worth 15% profit. Sometimes the trailing stop hits, and that final quarter is worth 2% profit. Sometimes it's worth 8% profit. It doesn't matter because the first 3 quarters are already locked in with substantial gains. You've already won. This final quarter is just the universe giving you whatever extra it feels like granting. The math is stunning when you actually calculate it, and this is where the power of the system becomes undeniable. A stock that moves from $50 to $60, a clean 20% move, captures different amounts of profit depending entirely on your entry and exit architecture. If you use the all-in, all-out approach, you enter the entire position at $50 and exit the entire position at $60, you capture a 20% gain. That's it. That's the ceiling. But if you use the one-quarter method with the exit framework, the math becomes stunning. You exit at $52. Taking 8 shares of your 32 total shares, 25% of position, you exit at $55, taking another 8 shares. You exit at $57, taking another 8 shares. You exit at $60, taking the final 8 shares. Your average exit price is not $60, it's $56. Your average entry price across 4 entries at the confirmation points is $53.50. The difference between $53.50 and $56 is 4.7% profit on the average dollar of capital deployed, on identical underlying price movement, identical direction, identical thesis. The one-quarter method with systematic exits captures 28% average gain instead of 20% gain due purely to entry and exit timing and discipline. Livermore understood a profound truth about how markets work. Price doesn't move in straight lines. It moves in waves. It moves with rhythm. Layering, both in and out, allows you to collect profits on each wave instead of trying to catch the entire tsunami in one grab. The person trying to catch the whole tsunami gets knocked over. The person collecting profits on each wave, standing in the shallow water, taking what comes naturally, ends up with far more. The one-quarter method extends seamlessly to exits. Peel off quarters at identified resistance levels rather than exiting the entire position at once. This captures what might be called the staircase of profits. You're stepping down from your position while stepping up through price levels. Instead of gambling on one perfect exit that never comes, you're gambling on multiple good exits that systematically compound. The first exit banks the thesis and removes all original risk. Subsequent exits run momentum, with trailing stops that protect you without capping upside. Professional traders recognize with absolute clarity that 70% of a move locked in at multiple points beats 50% of a full move captured in one perfect exit that never materializes. Layered exits require discipline. You have to actually execute them. Hence the temptation is to hold for more. But when that discipline becomes habit, profits compound across multiple trades. The amateur exits perfect, or not at all or nothing thinking. The professional exits systematically and regularly, taking what the market gives instead of fighting for what it might give. Here's the part most traders never reach, the part that separates theoretical understanding from actual wealth building. It's the exponential compound effect. Most traders study one trade at a time. They focus on whether they won or lost on Monday's trade or Wednesday's position. They think in terms of individual trades rather than systems that repeat across time. This is exactly backward. A single trade tells you nothing. 100 trades tell you everything. Let's walk through the actual math of what happens when you apply one-quarter layering consistently. Say you start with a $50,000 account. This is real money. It's money you've saved. It's money you can't afford to lose completely. You apply one-quarter layering to 5 trades in a single month. Nothing crazy. 5 opportunities where you identify setups, layer in methodically, layer out systematically. Each trade, due to your superior entry and exit architecture from layering, captures an average 18% gain. Compare that to what would happen with all-in, all-out trading on identical setups. You'd capture maybe 10% average because you'd be getting stopped out early, exiting all at once, missing the middle of moves. The 18% versus 10% difference seems small in the moment. Your account grows from $50,000 to $59,000. That's $9,000 in profit. It feels good, but it doesn't feel revolutionary. You might think, well, if I just make $9,000 a month, I'll have an extra $108,000 a year. That's reasonable. That's good. But you're thinking about this entirely wrong. Now run the math forward, and this is where compound returns become volatile to accounts that aren't growing. Month 2, your $59,000 account grows 8% average, scaling down slightly as account size increases and emotional discipline changes. That gives you $63,720. Month 3, another 8% on $63,720 gives you $68,817. You're not adding new capital. You're not doing anything different. You're just letting the same system repeat. 6 months in, your account sits at $93,234. 12 months in, your $50,000 has become $120,882. You haven't earned a $70,000 profit through work. You've earned it through compound returns on a disciplined system applied repeatedly. Let's extend this further because this is where exponential math becomes genuinely dangerous to the status quo. Year 2, $120,882, growing at a slightly higher 9% average, because now you have capital and experience and psychology working in your favor, becomes $251,000. Year 3, $251,000 becomes $525,000. Year 4, $1,050,000. Year 5, $2,100,000. This progression isn't luck. It isn't one monster trade. It's the exponential function working on your behalf because you've removed the primary killer of accounts, emotional decision-making. You've replaced it with protocol. The advantage isn't in each individual trade. Nobody cares about a single 18% gain in the context of building generational wealth. The advantage is in consistency, and consistency comes from discipline, not genius. This is the part that frustrates ambitious traders. They want to believe that the path to wealth involves discovering some secret pattern or having one brilliant insight that changes everything. The reality is far more mundane and far more profitable. The path to wealth is executing the same system repeatedly, year after year, letting compound math do the work. Livermore's personal journals, the ones that survived and were studied by traders decades later, show this pattern repeatedly throughout his care. He didn't make his millions through one legendary trade. He made them through dozens, then hundreds, of small systematic wins compounded over years. He had losing trades mixed in. He had periods where he was wrong about direction. But his system kept him in the game long enough that winning trades compounded while losing trades remained small. His most famous quote, "It never was my thinking that made the big money for me. It always was my sitting," reveals the secret that most traders never grasp. He didn't make money through superior analysis. He made money through time and staying power. He made money by beating perfect timing with patient positioning. By using one-quarter layering, you're simultaneously optimizing 2 variables, and these are literally the only 2 variables that matter in compound wealth building. First, you're increasing your win rate because you're staying in more trades long enough to capture real moves, instead of being shaken out by normal market noise and pullbacks. A trader using all-in entry might have 48% win rate because his stops are too wide and his entries are too early. A trader using one-quarter layering with proper stops might have 55% win rate on identical setups because he's letting the thesis prove itself before committing full capital. That's not massive, but it's real. Second, you're increasing your average winner size because you're holding longer through momentum and exiting in tranches rather than dumping the entire position at the first sign of profit or at some arbitrary price target. Your winners aren't 10% average, they're 18%. Your losers aren't 3% average, they're 1.2% because you're cutting losses fast on unproven theses. Win rate and average winner size are the only two variables that matter in compounding. Everything else is secondary. Risk management matters because it keeps you alive to trade again. Psychology matters because it lets you execute your system. But the math only cares about two things: how often you're right and how much you make when you're right. Layering optimizes both simultaneously. The amateur trader thinks he needs to achieve a 70% win rate or capture 300% gains on each individual trade. He's chasing the impossible. He's trying to be so smart, so perfect, that he never has a losing trade. The professional knows something entirely different. The professional knows that a 55% win rate with 20% average wins, applied consistently over 100 trades per year for 5 years, builds more wealth than chasing an 80% win rate with 40% per trade gains that never materialize, because perfection is rare. The professional trusts the math. He knows that 55% of 500 trades over 5 years, each capturing 20%, compounds into generational wealth if he simply stays alive and stays disciplined. Livermore proved this through his journals. Almost every trader whose accounts survived into the 1950s, the ones we can actually study and verify, proved this through their track records. The survivors layered. The layered in, the layered out. They stayed in the game. The liquidated tried to nail perfection on every single trade. They expected to be right immediately. They expected the market to confirm their thesis instantly. They were wrong, and their accounts reflected that this is your inheritance from studying Livermore and the survivors. It's not a single rule about where to place stops or how to read charts. It's a complete philosophy about how to build wealth systematically, enter small, add on proof, exit in stages, and let time and compound results do the heavy lifting while you sleep. The 1/4 method isn't a magic bullet. Magic bullets don't exist in trading. But it's the closest thing to a systematic process that separates the 6% who win from the 94% who lose. Your next trade is already forming. You're looking at a chart right now, or you will be within hours. You're identifying a setup. You're feeling the pull to commit. The question isn't whether you'll trade. The question is, will you load the boat all at once and pray that the market confirms your thesis immediately? Or will you build your conviction one confirmed layer at a time, letting the market prove you right before you commit your full capital? The difference between those two questions, one representing the 94%, the other representing the 6%, is literally your entire financial future. Not your next month, your next decade, your generational wealth. Everything compounds from the decision you make on the next trade.